Hello everyone and welcome to our video presentation on evaluating Big Diggers Limited capital structure using a WACC based financial analysis. We are group number 8, myself Aditya Sharma and my fellow student mates Ravi Kumar as well as Sunny. We're going to present this as follows. In this presentation, we will explore the composition and strategic implications of Big Diggers Limited capital structure, with particular emphasis on the weighted average cost of capital, or we can say in short is WACC. Let's start. Capital structure deals with an acquisition of money that a company receives in form of loan or shares. It makes a difference in the term of cost and risk in the financial planning. Big Digger Limited combines the two, as does the majority of the company operating in the mining industry does so. There is equity and debt as a part of the capital structure. Equity is the shareholders' money and debt is borrowed money. The equivalent reference has been provided in the slide and this is also included retains earning in the case of reinvested earnings. The company is better able to deal with cost and risk by maintaining a good balance. We can also see this by the comparison of the graph in the right hand side, in which on the top hand side, which is the components of the capital structure, we can see the top is owner's capital and borrower's capital. In owner's capital, we have three parts: equity shares, preference shares, and retaining earnings. And in borrowing capital, we have debentures and term loans. Let's talk about an overview of Big Digger's capital sources. Digger has three forms of financial finances, and those are two batch of bonds, regular and green. A giant bank loan and equity. A pie chart is able to indicate the level of contribution of each type towards the total financing in terms of market value. The highest being is the equity share, the lowest being the term loan, the second lowest is green bonds, and the bonds with batch 1 is unsecured is the second highest. Let's talk about what is WACC. The full form of WACC is weighted average cost of capital. WACC indicates the average change that company obtains on utilizing investor and lenders fund. It is a standard to determine whether project makes profit above the cost of the funds. To determine the WACC of Big Digger, the classic method was applied in an Excel sheet which has been submitted previously. Going further, my team member Ravi will be continuing the following slides and giving a more in-depth explanation of the data.
Hi everyone, I am Ravi. In this session, I will walk through a Big Digger's cost of debt, which is crucial part of calculating the company's weighted average cost of capital or WACC. Big Digger currently use three debt instruments: bond 1, which pays 5.5 yield semi-annually, a green bond offering 5% interest quarterly, and a term loan which charges 6.95% annually benchmark to the SOFR rate. Now it's important to remember that interest on debt is tax deductible. Big Digger benefits from a 30% corporate tax shield, which significantly lower the effective cost of debt. For example, bond 1 effective post-tax cost becomes 3.85%. The green bond drops to 3.5%, and the term loan cost is reduced to 4.865% after tax. This reduction makes debts more cost effective than equity. According to Yuliah, tax adjustable debt often provides a cheaper financing route for companies, especially when expenses are substantial. Next, we'll look at the cost of equity. which we calculated using the capital asset pricing model or CAPM. The CAPM formula is cost of equity RE is equal to risk-free rate RF plus beta market risk into market risk premium, where risk-free rate is 4.15%, beta is 1.265%, including Big Digger slightly above average market risk, and the market risk premium is 6.7%. Substituting this into the formula, we get 12.69%. This means that equity investors expect return of 12.69% in exchange of the risk they bear. This return reflects both market condition and Big Digger's individual risk profile. As Dobrowolski explained, the CAPM model remains widely used because it links expected return directly to systematic risk, giving us a clear benchmark for what shareholders require. Finally, let's put the pieces together. The Big Digger weighted average cost of capital (WACC) is calculated by combining the cost of debt and cost of equity, weighted according to their proportions in the company's capital structure. In this case, equity makes up larger share of the total capital, and since equity is more expensive than the debt, the influence of WACC more heavily. This resulting WACC is 12.13%. This is the minimum return Big Digger needs to earn on a new investment to satisfy both debt and holders and shareholders. As highlighted by Jhoansyah, equity capital, while more stable in the long run, generally costs more due to high risk and lack of tax deductibility. And this is clearly reflected in our result. Thank you.
Hi guys, this is Sunny and I will be taking it from here. So what does our weighted average cost of capital means? This means any new project Big Digger invests in must earn more than 12.13% to be worthwhile. So our final WACC is 12.13, which actually tells us the minimum return Big Digger should make on any new project. Since this is a bit higher than the industry average, it means the company might be seen as a little less competitive when looking at the good investment. So one reason for this, we can say, a company's capital structure, where we can see more equity than a debt. So equity usually means more cost. And getting to the next slide. So here, as we can see, many things are affecting the capital structure, and it can also be categorized into two factors: internal and external. So internally, how much risk the business is willing to take, and what kind of asset it has, and how profitable it is, all matters. So if we talk about externally, external market interest rate and investor trends play a big role. So here Big W choice of issue green bond, so it's trying to appeal to the investor who cares about the environment, even though the profit, even though they are sharing lower profit. So looking at the advantages of current capital mix, here Big Digger's current capital mix has a very strong benefits, because it does not much rely on debts, and its financial risk is very low. It also has flexibility, and thanks to its strong equity base, and by using green bonds, it builds trust with socially responsible investor. And adding all together, this approach supports long-term stability and ethical business value. So in short, if I have to say, long debt is equal to low financial risk, strong equity base is equal to flexible funding, and green bonds, which shows good reputation and trust. So let's go to next slide. So here, if we ask what could be improved, Big Digger has an opportunity to increase the amount of debt to reduce weighted average cost of capital. So even though Big Digger's capital mix is safe, there's a room to improve. Debt is currently cheaper than equity here, so increasing it slightly could reduce the overall weighted average cost of capital. But this needs to be done carefully so we don't add too much financial risk. And any changes should be aligned with the company's long-term strategy and how the market is behaving. So a reasonable modification would enhance performance that would not negatively affect stability. So to sum up, the capital structure is the way through which a firm finances itself. And so capital structure decision really affects how much it costs a company to raise the money. And here, if you see Big Digger's heavy use of equity gives it stability and ethical strength, but it comes with a slightly higher weighted average cost of capital. And if the company wants to be more cost effective, a small increase in debts done strategically could help improve profit without hurting its financial safety. So just wrapping things up here, capital structure, we can say a mix of equity in debt, and Big Diggers mostly uses equity, so its weighted capital cost of capital is 12.13%, and here current mix is equal to stable, ethical, and low risk, so which is fine. A small shift toward debt could reduce cost and improve return. Okay, saying this, I would like to conclude here. Thank you.